I'm going to give you a speech without a joke, I'm afraid. So, charge your glasses and prepare yourselves. Because I'm going to speak about a serious subject with a serious group of people who have done more than anyone else to address the issue. But let me first say that I'm very grateful to Lloyd's for this invitation, to John and to Inga. This honor of speaking at the first city dinner in this magnificent eponymous room. And to speak to Lloyd's, which is the bedrock of the UK, in many respects, global insurance industry. Since 1688, Lloyd's has, in the great tradition of the city, served both the UK and the world, providing protection against the perils of the age, helping enterprise, and I underscore enterprise, to thrive. From its origins, marine insurance, the Lloyd's market has evolved constantly to meet the needs of a rapidly changing world, a point that John just made. The first excess loss reinsurance was created here. Modern catastrophe cover was born with your decision to stand by the policyholders after the San Francisco earthquake. Lloyd's pioneered aviation insurance, and with eyes constantly on the horizon, Lloyd's has remained at the forefront, and as you said, John, the innovation at the heart of Vision 2012. Today, you're insuring new classes of risk in new parts of the world, from cyber to climate, from space to species, from Curitiba to Chengdu. And you're doing so in market conditions that are as challenging as any in the last 20 years. This need to manage emerging mega risks is as important as ever. Because alongside major technological, demographic, and political shifts, our very world is changing with profound implications for insurers, for financial stability, and for the economy. And I'm going to focus on those risks, as John referenced. I'm going to focus on those risks from climate change this evening. Now, there's always room for scientific disagreement about climate change, just like any other scientific issue. But I've found that insurers are amongst the most determined advocates for tackling it sooner rather than later, and it's little wonder, while others debate the theory, you deal with the reality. Since the 1980s, the number of weather-related loss events has tripled, and on an inflation-adjusted, as you would expect from a central banker, on an inflation-adjusted basis, insurance losses from these events have increased from around $10 billion per year during the 1980s to around $50 billion annually over the past decade. But the challenges currently posed by climate change pale in significance compared with what might come. And the far-sighted amongst you, and we know this from a survey we've just done, the far-sighted amongst you are anticipating broader global impacts on property migration, political stability, as well as food and water security. So the question is, why isn't more being done today to address it? Well, the classic problem in environmental economics is the tragedy of the commons. And the solution to that lies in property rights and supply management. But climate change is a tragedy of the horizon. And we don't need an army of actuaries, even though we do have an army of actuaries in the PRA under Andrew's leadership. We don't need an army of actuaries to tell us that the catastrophic impacts of climate change will be felt beyond the traditional horizons of most actors. It will impose costs on future generations that the current one has little direct incentive to fix. In other words, future costs beyond the business cycle, beyond the political cycle, and certainly beyond as well the horizons of technocratic authorities like central banks who are bound by their mandates. After all, the policy horizon for monetary policy extends out 2 to 3 years. And for financial stability, it's a bit longer, but at its extreme, it's out to a decade, which is the extreme of the credit cycle. In other words, once climate change becomes a defining issue for financial stability, it may already be too late. And that paradox, that tragedy of the horizon, it runs deeper because risks are, of course, a function of cumulative emissions, meaning that early action is less costly. The desirability of restricting climate change to 2 degrees above pre-industrial levels leads to the concept of a carbon budget, which is an assessment of the amount of emissions the world can, quote, afford. And such a budget highlights the scale of reaction tomorrow necessary for inaction today. Now, those actions will be rightly influenced by policy choices that are the responsibilities of elected governments advised by scientific experts. And in 10 weeks, representatives of 196 countries will gather in Paris at the COP21 summit to consider the world's response to climate change. Those governments, in effect, are choosing whether and how to pursue that 2-degree world. And so the question, given that introduction, the question is, what role for finance? Well, earlier this year, the G20 finance ministers asked the FSB to consider how the financial sector could take into account the risks that climate change poses for our financial system. And as chair of the FSB, I've hosted meetings, including one last week, where the private and public sector have discussed those risks and what might be done to mitigate them. And I want to share some of those views after providing some context looking at the example of the insurance industry. Now, there are 3 channels through which climate change can affect financial stability. First are physical risks, or the impacts of physical risks, familiar to virtually everyone in this room. The impacts today on insurance liabilities and the value of financial assets from climate and weather-related events that damage property or disrupt trade. The second are liability risks, or the impacts that could arise tomorrow if parties who suffered loss or damage from the effects of climate change seek compensation from those they hold responsible. And finally, transition risks, or the financial risks that could result from the very process of adjustment to a lower carbon economy. The speed at which that adjustment, that repricing occurs, is uncertain and could be decisive for financial stability. And there's already been a few high-profile examples, including in the last weeks, of jump-to-distress pricing because of shifts either in environmental policy or performance. One of my core points is that risk to financial stability will be minimized if the transition begins early and follows a predictable path, thereby helping the market, and I'd underscore the market, to anticipate a transition to a 2-degree world. So to draw out those points, let's consider the Bank of England's and the PRA's current approach to the insurance sector. As regulator of the world's 3rd largest insurance industry, the PRA is responsible for protecting policyholders and for ensuring the safety and soundness of insurers. Our supervision is forward-looking and judgment-based. It's risk-based and proportionate, tailored to different business models, and it considers both business-as-usual events as well as whether a firm can fail safely. While our mandate is to protect policyholders, many of whom are local, we are very conscious of the need to raise standards outside our shores. And Solvency II, for all its difficulties, is a good example. It is prudent but proportionate, and it's a directive that embodies the core principles of our domestic standards and embeds them more consistently across Europe and replaces a patchwork of regulation in Europe amongst your European competitors. Another example of best practice converging globally is the FSB's agreement last week on higher loss-absorbing capacity for globally systemic insurers, as well as its support for the IASB's completing its new insurance contract standard. So the UK insurance industry is well prepared for both of these developments as higher standards globalize. Now, of course, forward-looking regulation must consider the impact of emerging vulnerabilities on business models. And that's why the PRA has been working these last several months with regulated firms, including many of you in this room, to produce for DEFRA a review into the impact on climate change on British insurers. And that report, which has just been published today, concludes that those insurers stand exposed to each of the three types of risk that climate change poses to finance. It notes that the insurance industry here is well placed to respond in the near term, but it cautions that its ability to manage risk today doesn't mean that the future is secure. Longer-term climate risks could have severe impacts on you and your policyholders. Let me draw that out. The direct costs of climate change are already affecting insurers' underwriting strategies and accounts. For example, work done here at Lloyd's estimates that the 20-centimeter increase in the sea level at the tip of Manhattan, this increase since the 1950s, increased by 30% the insured losses from Superstorm Sandy. Beyond these direct costs, there's been an increase in indirect costs and market losses through second-order events such as disruption of global supply chains. And so insurers are therefore amongst those with the greatest incentives to understand and tackle climate change in the short term. Incentives that are sharpened not just by your commercial concerns as capitalists, but as John Nelson just alluded to, your moral considerations as global citizens. And your response, the response of Lloyd's, the response of the UK insurance industry, is at the cutting edge of understanding and management of such risks. Lloyd's underwriters were the first to use storm records to mesh natural science and finance in order to analyze changing weather patterns. So events like Hurricanes Andrew, Katrina, and Ike have helped advance cat risk modeling and provisioning. Today, Lloyd's underwriters, as you know, are required to consider climate change explicitly in all of their business plans and underwriting models. And your genius has been to recognize that past is not prologue and that the catastrophic norms of the future can be seen in the tail risks of today. So the combination of your forecasting models, a forward-looking capital regime, business models that are based on shorter-term policies, means that general insurers are well placed to manage the physical risks in the near term. But recognizing that, looking further ahead, there is a business model question. As these physical risks increase, they could challenge general insurance business models. Because without action to mitigate climate change, policyholders will begin to feel the impact as pricing and coverage adjusts, and this could pose wider issues for society, including whether to nationalize risk, as we've seen recently in this country. Physical risk from climate change will also become increasingly relevant to the asset side of your balance sheets. While the ability to reprice or withdraw cover mitigates liability risks, you have to be careful not to suffer from cognitive dissonance within your organizations whereby the underwriting